All right, greetings everybody. Welcome back. Happy Wednesday. Hopefully everyone's having a great day, having a great week, all that stuff. Chris here bringing you another weekly Wednesday discussion. And it is my pleasure to welcome you if you are new, and if you're returning, of course, then hey, welcome back, my faithful crew. Nonetheless, today we are going to dive into the world of the MACD. This is something that we actually have talked about before in the past. It was requested that we go over it again because it was a long time ago that we actually covered it. So here we are. As always, it's always my goal to bring you something interesting to talk about each and every week. Sometimes we cover indicators. Sometimes we cover just general market news. Sometimes we cover assets themselves. There's a lot of different things. We always try to change it up each and every week. But today will be an indicator spotlight, and we'll be diving into the MACD. So without further ado, folks, let's go ahead and jump on into our disclaimers and move on into the juicy material that follows. As always, guys, this is the time where you get to sit back, sip on the coffee. That's exactly what I'm doing at the moment, and enjoy the disclaimers that haven't changed a single word of them. They are exactly the same as they always have been. So if you already know them by heart, then hey, you're already good to go. But once again, we are required to do this. I'm not doing this just to torture you, I promise. But we'll get through these as soon as possible, even if you don't feel like they even pertain. Alrighty, moving along. Moving along. Moving forward, still, I think we have just one more after this one. So we are just about there. Last one, folks. Last one. Alrighty. Time to rock and roll, our favorite time of the day. So once again, guys, we're going to be talking about the MACD today. Now, what is the MACD? Obviously, that's an acronym. It's a shorter abbreviation of the long version of this wonderful indicator. It is called the Moving Average Convergence Divergence Indicator. All right, so that's what the MACD stands for, Moving Average Convergence Divergence. So it's a relatively simple indicator. Excuse me. It's a relatively simple indicator. And before we get going any further, let's go ahead and switch on over to some charts here. And let's get it on the charts. Now, if you're using the Finemark platform, just follow along because I'm going to show you exactly how to apply it on our charts. If you're using another platform, no big deal either, but the way you apply it might be slightly different, but somewhere it is going to be listed in the indicator option. Most likely, it is a very widely offered indicator. It's been around for some time, and it is something out there that is quite juicy for us. So nonetheless, let's go ahead and get that going. So when we have our charts open here, and once again, with the Finemark platform, we've got our charts open here. We already have price located on an asset that we're interested in. We have our charts set to the time frame that we're interested in. All we're going to do is go over here to this little indicator button, the same one that we do to add all of our indicators. We're going to click that show indicator options. After we click that, we're brought up with all of our menu options. Now, this is where we have to get a little bit tricky. It's not something that directly overlays price. So you don't see it initially, all right? You don't see it under the available indicators under your section 1 category because your section 1 category is just your current price. So what we're going to do is we're going to create a new section. Boom. Now we have section 2. Section 2 has now given us another section on the charts. You can't see it clearly because it's behind the screen. It's kind of opaque in the background right now. But if I go ahead and close off this just to show you what happened, by adding a section 2, it just split the charts. It divided the charts. And every time we add a section, it throws another line and gives us literally another section. So that's what's going on there. So let's get back to that. So once we've added our section 2, we've now opened up the availability. When we click on this, once we highlight section 2, click on it, we have all kinds of indicators that now present themselves. And the reason they're presenting themselves is because these are all the indicators that are available that aren't meant to overlay price. Whereas before we had a shorter list because those are all the indicators that are meant to overlay price. So different category here. So for section 2, we're going to go through here. And naturally, it's all alphabetical order. So we're just going to scroll on down to the M's. The M's like mother or meatballs or whatever you want to think about. So here we have the moving average convergence divergence, right? So that is the long word for MACD. If your platform, if you're not using Finemark, it might literally just say MACD, but the full name is going to be moving average convergence divergence. All right, so we're going to go ahead and click that. All right, and now that I've clicked that, we see it over here under section 2. And we have the ability, as always, to adjust any settings if we so choose, which would be over here. And right off of the bat, I'm going to change some settings. We'll talk about them in just a second. But I'm going to change some settings over here. I'm going to make this guy, we'll make this one blue. And if you didn't know how to change the colors of, some of the different indicators you're using, now you do, because at least on the Finemark platform, nonetheless. And we're going to make this one red. The default colors, I think, are too close. So I do actually prefer blues and reds or greens and reds. I like both. It just depends on what color chart background I'm using and everything else. And other than that, we'll leave the difference the same. But you see a few different options here. And up at the top, you'll notice that it says fast, slow, and signal. Okay, we're going to talk about all these things momentarily. We have a difference, a MACD, a signal, and a zero. And these are all just different color options that we can change, referencing each of these lines, plus, obviously, the blue stuff down here, which it says difference. The difference you don't see up here, that's not something you can change. That is just representing the difference between the lines that we're going to be talking about, which will be the MACD line and the signal line. Okay, so I'm going to click Save, and we're going to go see if it applied all those things. And what do you know? It did. So now we've got a blue line. Excuse me. Now we've got a blue line for our MACD line, and now our signal line is red. Now we will begin our journey talking about what in the world the MACD is. So I already mentioned that it is something that's widely available. You know, the MACD is one of the most popular and broadly used indicators out there for Forex traders, futures traders. It is something that is widely used. It's been around for a while. Some people love it and some people, you know, don't include it in their trading arsenal, and either or is fine. Whatever you find success with is obviously going to be the most important thing to you, okay? But the MACD, like we said, it stands for the Moving Average Convergence Divergence, and the indicator itself, which requires a moving average as its input, falls into the group of lagging indicators. So this indicator that we're seeing down here in the bottom, it's qualified as a lagging indicator, okay, because it is using a moving average, and moving averages are lagging indicators. They're not meant to be predictive in nature, despite being able to use the information to be predictive in nature, so don't get them confused. We've talked about the differences, obviously, in the past. But the basic function behind the MACD is to discover new trends and to help identify the end of current trends. And there's a lot of different ways to gauge the different signals that are generated by the MACD. And you'll find in your, you know, your ventures, if you start investigating people's experience with the MACD and vice versa, you'll find that as people get very comfortable with the MACD, they may be using different signals than the default settings. Now, the default settings are actually what are provided here on Finamark. Those are the widely used universal default settings, which once again, is going to be, we'll talk about those in a second, but it's going to be the 26, the 12, and the 9, okay? But anywho, we'll work our way into that. Don't want to jump ahead. So as we're, you know, working our way to understand what the heck we're looking at down here, you know, the MACD itself is generally placed at the bottom of a chart. No matter what your platform is, as you can see here, it is placed at the bottom of the chart. Now, if you're using your MACD on a different platform, the most likely difference between yours and mine right now would probably be the difference bars, okay? So on this histogram, which is what this is called here, you're gonna notice that the bars are pink on my screen. Now, your bars might not be. So that is going to be something that is obviously, you know, once again, just a color preference. There's no real reason aside from it. The information it's providing should be the same if you have the default settings that we were talking about. You can set it to, you know, any color that makes your heart happy. But anyway, so the window is generally below price, which is going to be correct in what we're currently looking at. And then the moving average convergence divergence is a relatively easy to use tool. So that makes the MACD kind of fun and beginner friendly. But obviously, we want to understand it fully before we attempt to use it in our, you know, live trading. And definitely, as with all things, guys, we always encourage using a demo account while you are learning to kind of save yourself any unnecessary mistakes that could be costly while you're, you know, figuring things out and working the kinks out. So the MACD indicator itself, down here at the bottom, it consists of 3 components. There are 2 lines and a histogram. All right, we already talked about that. So we've got 2 lines and a histogram. The histogram is the bars underneath, and that essentially just represents the difference between these 2 lines. Think of it that way. So as the blue line and the red line on my screen get farther apart, you'll notice that the bars get larger, okay? And when the lines are on top of each other, like they were over here, with very little difference between them, there was almost no size in any of the histogram bars, because once again, they're just representing the difference between the lines. So pretty simple to understand there. So the MACD line, which is going to be, in this case, the blue line. Remember, we changed that, and we'll go back just to show you. So we have the blue line and the red line. Those are the 2 we're going to be talking about now. So let's go ahead and highlight section 2, click on the cog wheel. So the MACD line, as you can see, I made it blue. And then we have over here to the right of it, we have the signal line. So these are the 2 things we're going to be talking about now: the blue line, the red line. The blue line is the MACD line. The red line is going to be the signal line. Just remember that as we go forward, but nonetheless. So the MACD line is going to be the faster line in the indicator. All right, it reacts faster and it is more sensitive, and it generally moves above and below the second line, which is the signal line, more likely than the other way around. So think of one as a shorter term moving average and one as a longer term moving average. All right, the shorter term is always going to react faster. So the signal line, the MACD signal line, is the second line here. This is the red one. And it's called a signal line because it generates the basic MACD signals. All right, now since the line is slower, it frequently is breached by the faster MACD line, like we were just talking about. And then the next thing to mention here is the histogram. All right, and the histogram just simply represents the difference between the MACD line and the signal line, like we were saying. So the bigger the gap between the lines, the higher the bars will be on the histogram. All right, the less the gap between the lines, the lower the bars will be. Okay. Now, as we talk about those settings, let's go ahead and pull that back up. So default settings here on the MACD, as you'll see. The default settings up here, where you see fast, slow, and signal. Okay, fast, slow, and signal. So on most trading platforms, the MACD indicator is usually using these default settings that you see. The parameters of 26, 12, and 9. They are going to be the numbers that you are generally going to be given with every platform out there. And if your platform doesn't have them, it is important to know these numbers in case you are, reading some type of tutorial out there that's relying on default numbers, default parameters, so you know how to reset yours to what they are. So there you go. So 26, 12, and 9. And we're going to talk about them. So the 12 and the 26 are mutually related, which are these two, the fast and the slow. So the 12 and the 26. Boom. Okay. These two numbers concern the calculation of the faster MACD line. Okay. The structure of the MACD line, once again, which is the blue line, all right, the structure of the MACD line comes with calculating a 12-period exponential moving average, which we have here, okay, on price action, and then subtracting a 26-period, which is over here, exponential moving average from the result, okay? So the difference between these two EMAs gives you the value of the faster line, okay? All right, so let's go ahead and close out of this guy, and we'll just keep talking about it on the main screen so we can keep looking at it, all right? All right, so the 9, all right, the last number, the 9, comes from the calculation of the slower line, which is the signal line, okay? The signal line, being the red line, obviously, is going to be a product of a 9-period exponential moving average plotted on the faster MACD line, which is why the signal line is always slower than the MACD line, because it's the smoother version of the MACD line, because it's plotted on the MACD. Make sense, right? So although the MACD indicator consists of only 3 components, we have the 2 lines in the histogram, it does provide a myriad of different signal opportunities for traders out there. And there's a lot of various uses that traders are using, and we're going to start talking about those next, okay? There's quite a few. I believe there's 6 roughly very common versions, and we're definitely going to cover some of the top 3 for sure. And diving right into it, probably the most common MACD signal, quote unquote, that traders are using is going to be the MACD crossover. Okay, the MACD crossover. So this is going to involve some flipping and flopping here with our lines. Obviously, our MACD line being the blue line and the red line being the signal line. So the MACD crossover involves an interaction between those 2 MACD lines. The MACD line is faster, once again, the blue one is faster than the signal line, and it will typically cross above and below the signal line, giving what we call a crossover. So a bullish MACD crossover will be when we have a MACD line, which is our blue line, crossing the slower signal line, crossing above the slower signal line in a bullish manner. So let me give you an example of that here. Okay, I don't know why I stuttered so hard there. So right here, this would be an example at the bottom of our charts. Let's kind of zoom it in so it's a little bit easier to see. Right here, in this area, we have a blue line crossing above a red line. Remember, the MACD line is the blue line, and the red line is the signal line. So if the blue line is coming above the red line, we consider that a bullish interaction. We're seeing the bullish MACD crossover. We're seeing the MACD line cross over the signal line. So this is a bullish MACD crossover, and this is generally considered to be a bullish signal in the market, meaning it might be a good time to consider some type of a buy opportunity. Okay, obviously there's more that's going to go into it than that if you want to be a little bit more precise, but that is the general information that the MACD indicator in and of itself is providing us. Whether you're using it by itself or in conjunction of other things, that is how we're going to interpret a bullish crossover. So once again, blue line crosses above the red line. At this time, we are going to be in anticipation of a bullish event. And actually, if you look at the market here, and let's go ahead and get my annotation tool up and running. Let's go with that. All right, wonderful. This will work. So once again, we're paying attention to this little area here in the market. This area on our MACD. So in this white box, we notice the blue line cross above the red line. And look what happened at this time. So if we just follow this straight up here, which is the time that the market made the cross, what was the general trajectory of the market after that point? You know, it's not too hard to see here that after the bullish crossover, we witnessed some bullish activity in the market. So the MACD would have given us a nice little insight had we been paying attention to it at this point. Now, if we go looking and hunting for a bearish version, okay, the bearish crossover, let's see how that happens in the market. We have one right here that we'll just use. Why don't we use this guy? All right. So once again, what we have here is a blue line crossing below a red line. So instead of being a bullish one where we're expecting the market to obviously be rising, now we're just reversing it, and we have a blue line crossing below, which is our MACD line crossing below our signal line, which occurred once again right here. So we're going to kind of give ourselves a nice little box in the market and pay attention to this area, and we'll just follow her on up and see what happened. Okay, so after the MACD line had us or gave us a crossover there where we would consider it a bearish crossover because we were crossing below the signal line, the faster MACD line moved below the signal line, indicating that there might be some bearish activity coming in the market. We actually were met with some bearish activity in the market. Now, once again, something to take into consideration is the histogram. The histogram itself obviously is going to represent the difference between the two lines. The larger these bars are, generally speaking, the more solid the read. Okay, the more solid the read. If we have these bars and they are quite large. Now, my charts are zoomed in right now, so it's got everything out of scale. This was actually more of a bearish event than it currently looks. I know it looks a little flat because we're zoomed in so close, just to show you guys the difference here. But this is, if you start zooming out, and I can't because of the drawing at the moment, but nonetheless, the idea is the larger the bars, guys, the stronger the read, the stronger the divergence, the stronger the action that is happening. So if we have a large deviation here between, or separation between the two lines, we have large bars down here on the histogram indicating that, just to make it a little bit clearer on our eyes, then generally speaking, we are anticipating or witnessing some strong activity in the market conducive to whatever it's saying. So if the bars are upside down, pointing downwards, we have a large divergence here where the MACD line is below the signal line. That means that we are probably witnessing a strong bearish event, and vice versa. So if we witness these bars get quite large and we have that divergence, then we are, or not, I'm sorry, not divergence. We have that that crossover situation, then we are going to be in a situation where we probably have a very reliable read. All right. But that is the first version of signals that people like to pull with a MACD. And that's just simply a crossover. That's all it takes to get that read out of the market. Now, once again, we always usually want to use that information with conjunction of something else, some other layer of confirmation. But the more we know and the more reason that we have to justify why the market is looking to rise or why the market is looking to fall, the better off we are. So overall, using the MACD to find out this information when used as a note-taken scenario can be very helpful without really a whole lot of downside there. Once again, you just consider it a note taken or considering it a bearish activity instead of just simply jumping in for a buy every time. Now, some traders do that, but once again, I would encourage using it as a note taken. We have bearish conditions present, and we're using it in conjunction with other things to monitor the market. So let's go ahead and erase these lines off screen and kind of zoom her out a little bit here. Let's just, I'll leave it for now. So as we move along, okay, as we move along, that is the first way that traders are finding signals with the MACD and using them for entries. The second most common way is going to be the divergence, okay? And you might have heard me say the word divergence. That's because I got myself excited working away in here. The divergence is my personal favorite, okay? The divergence is a very valuable piece of information, albeit it is a little bit trickier, okay, so to speak, a little bit trickier to understand. So the price action on the chart, meaning the candles themselves, whatever it is that you're using to plot the history of price. When we start noticing, and we'll see if we can find one. If not, I'll use an image. I've got some images ready for you. When we start noticing a divergence in the chart, which would look something akin to, let's zoom it out a little bit farther. We've got a little bit of a divergence here, okay? So this is going to be a situation where we have a divergence, and what I mean is we have price going upwards while the MACD is going downwards, all right? So we have a divergence, all right? So if we take a white line and we say, all right, let's pay attention to the trajectory of the highs here, okay? Just a rough idea here. Roughly, the highs are continuously getting higher, and also the lows are continuously getting higher. And meanwhile, at the same time on the chart, what are we witnessing down here? Okay. We're actually witnessing the MACD lines themselves setting lower highs on the lines and setting lower lows. So what we have is a disparity. We have a situation where price is rising, but the MACD is falling. And what is this usually giving us an indication of? Well, the divergence gives us an indication that despite prices rising, the power behind the market in and of itself, the momentum is most likely hinting at us that we're looking like some type of change is very, very possible in the imminent future. So as we notice this, okay, and these are usually longer term trend changes that it's giving us a clue into, we pay attention to this divergence, and then we can use it in conjunction with simple price action tools like support and resistance. So if you notice the market starts building a heavy area of resistance, and you notice that it's actually been setting or it's been proceeding with a bit of a divergence here. In this case, this is what we're going to consider a bearish divergence, because we expect the market to react bearishly to what we're currently looking at. The reason is price is rising, but the MACD is falling, and something's got to give. And generally speaking, it's the MACD that wins. So if price is rising and the MACD is falling, usually we're going to see a fall in price. And opposite is held true if we had a bullish divergence. So a bullish divergence would just simply be the opposite. If we had price falling, so if price was going down, for example, and then meanwhile the MACD was rising, we would be on the lookout for some type of bullish activity to come. And these trigger points can be as simple, let's get rid of this for now. Okay, these trigger points can be as simple as just paying attention to something like resistance. So here you'll notice that we had a little bit of resistance where the market got stuck. Again, we came up and kind of tried to test this area and got stuck a little early. Then we came up and kissed it one more time, got stuck. Then we tried to come up again, had a pretty hard shutdown that actually brought us to a new low in price. At this point, we've got a very bearish event coming, because now we've had a period where our lows are actually starting to get a little bit lower and our highs are getting plateaued and we're getting stuck. And as we come up one final time here with this long wick, we come up and bump resistance. And then guess what begins? A very long and powerful decline here. Well, I shouldn't say a very long, because we're on a 15-minute chart, but a powerful decline nonetheless. It's all relative. So we had a powerful decline occur in the market after running into resistance. Now, how can we use this to benefit us as traders? Well, if we pay attention to a divergence that's occurring, which you can see down here quite clearly, they're not too hard to find with a little practice. If we realize that we're in a state where there is a divergence occurring, the first thing we have to ask ourselves, is it a bullish divergence or is it a bearish divergence? All right. And we always use this relative to the way that we anticipate the market to go. And we anticipate the market to go in the way that the MACD is preferring. Okay. So we give power to the MACD. So if the MACD is sloping downwards while price is rising upwards, that is a bearish divergence. And we are anticipating some bearish activity. Okay. And then the opposite holds true, right? If price is falling and the MACD is sloping upwards, then we're going to call that a bullish divergence, because we are anticipating a bullish move to come. Okay, so all we have to do with the concept behind the simple, divergence strategy that traders are employing with the MACD is pay attention to which way the divergence is going in regards to the MACD, and then simply prepare with some type of logical justification, even if it's just simple price action like support and resistance, which I personally am a big fan of. I think that keeping it simple, the keep it simple stupid method, the KISS method, generally results in better results. There we go. Generally results better is how we're going to word that, than people that or strategies that tend to overcomplicate things. you know, kind of muddle up the charts so much that you can't really see what's actually happening. Sometimes just paying attention to where price is rejecting off of and how it's rejecting off of it can be infinitely more valuable than trying to use 1,000 different indicators to muddle it up. So I always recommend using maybe 1 or 2 if that's what you're going to do, and then use your price action as your confirmation layers thereafter. Yeah, I'm not a big advocate of using, you know, 4, 5, 6 indicators all on one chart all at the same time. Now, if you want to go through all those things, that is absolutely fine, but you're giving yourself more information to interpret, and you're giving yourself more work to do to interpret that information as well, because you got to pay attention to a bunch of different indicators and hopefully weed through the mess. Or if you've got it set up on a bunch of different charts, even though it's all the same asset that you're monitoring, just, you know, a bunch of different screens, that's, once again, that's all well and good, but once again, it's just a lot of work, and you don't want it to detract from what's really happening in the market, which is always going to be displayed by those darn candlesticks. So once again, just paying attention to it. All we did here was find a little bit of resistance, We found the inability for the price to continue higher. Price was having a hard time getting higher, and we had witnessed a divergence going on for a long time. And the more times that we start rejecting from this area, and the lower these lows start going, and the more sharp they get, the more abrupt the drops become, the more power and volume goes into these drops, the more we can articulate a justification for some type of a short position, because we are seeing a weakening in the market and we're preparing for the reversal that the MACD was hinting at all along. So that is how we would be using a MACD divergence. So a little bit more complicated than a simple crossover entry, but nonetheless very valuable. And this is my favorite method of using the MACD. Okay. All right, so we're going to go ahead and get rid of that. And once again, the MACD bullish and bearish version of the divergence is just going to be relative to which way the MACD is sloping, contradictory to where you're seeing price rise. Okay. Now the third thing that we'll talk about with the MACD is going to be overbought and oversold indications that the MACD can absolutely provide. So if we look at an overbought scenario, what would that be with the MACD? Well, the overbought MACD, okay, so an overbought MACD is going to be when the MACD line, which is, once again, is our blue line, zoom in, our blue line. So an overbought scenario would be when our blue line gains a relatively large distance from the signal line. So we're going to see large histogram bars, tall histogram bars, okay, either up or down. And we're going to see a nice separation here between the blue and the red. All right. So when we see a nice separation here, and it's in a scenario where if it was, the blue is going to be below, if we have a large blue line below the red line, or I'm sorry, a large distance between our blue line and our red line, and the blue line is below, that's our MACD line. If the MACD line is below the signal line, and price is increasing, okay, that's an example, all right? You can consider it in the same logic as the divergence, but we're not talking about an entire period of peaks and valleys here. We're not looking at a total session of all the lows on the MACD line and all the lows on the chart of price itself. Instead, we're paying attention to a period in the market where the lines have a large separation, with the blue line below the red line, and meanwhile we have price increasing. That's an example, okay? That's an example of an oversold scenario, okay? When the blue line gets far below the red line, we're considering that a time where the market is a little bit oversold. Generally, that happens when there's a little bit too much buying in a relatively short period of time, and we consider the market to be oversold, and we're going to anticipate these lines to squeeze back together. So one thing that you're going to see with these lines, obviously, is they will get far apart at times, but they do always come back together. All right, they will always cross over at some point or another. So as you can see here, we got far apart. Then what happened? The MACD started squeezing back down, and it actually crossed underneath and went for a bit of a bearish ride. Not a far one, but we had a slight slope here from these highs to these lows where we kind of plateaued off. So slight bearish activity. And this was hinted by the MACD finally getting a little bit overbought. And now we know it's overbought in a scenario where the blue line is going to be well above the red line. Okay, well above, meaning we got a big gap here. The gap, if the gap is large, Okay, there is going to be an expectancy here that we are a little bit overbought, and we are going to expect some return to normality, if you will, or to just the status quo, or the to find that regularity in the market, just like the Bollinger Bands do. So with Bollinger Bands, as we've talked about in the past, we know that somewhere around 80 to 90% of all price movements exist inside the Bollinger Bands. Okay, so with the Bollinger Bands, if we know that we're going to anticipate the price to stay inside Bollinger Bands around 80 to 90% of the time, if we're outside of those bands, what are we expecting? Well, if 90% of the time we're inside the bands, we are expecting a return to being inside those bands. And that same concept applies to a deviation of these lines, or a separation, I should say, of these lines. So when that MACD line gets quite a bit above the signal line, we're going to be on the lookout for a balancing in the market. We'll be on the lookout for the market to kind of squeeze these lines back together. And what squeezes these lines back together? Well, generally speaking, a move in the opposite direction of what separated them. Okay, you understand the concept? So when we have a large separation here where the blue line is way on top of the red line, that usually occurs because we had something like this. Okay, so right over here, we had a very strong bullish price movement, and that created the separation that we had down here. Okay, powerful price movement, powerful separation. Okay, well, as we continue, we know that we're expecting some return to normality, so we can be on the lookout for what simple things. We could be as simple as resistance, just like we were talking about with the divergence. So as we run into some level of resistance and we know we had a large separation here, what can we be on the lookout for? Well, I'll return in the lines where the lines start to squeeze back together and possibly flip. They didn't only just squeeze back together, but they did flip here. But what did we end up with? We ended up with a downward slope in price. Okay, and the opposite holds true. All right, the opposite holds true. If we have a strong deviation, all right, down here, for example. Now, this isn't the strongest deviation in the world. I'm just using it as an example. So there's definitely better out there, just throwing them on the fly. But this would be an example where we're considering the MACD to be a bit oversold because the MACD line is getting a little bit too far below the red line, which is our signal line. And that generally occurs because we have a sharp sell-off in price, which is what we had. Okay. And what do we expect if the MACD lines get separated quite far? Well, we expect that at some point they are going to be returning to a level of normality. They're going to kind of come back and touch each other and potentially flip. Okay. But at the very least, we expect them to come back and get a little closer together. So we want to be prepared for when they come back to get a little closer together, because that is generally done with what in this scenario? Well, if it's oversold, we're going to witness some type of buying to tighten those lines back up. And how are we going to, prepare for that? Well, we're going to be on the lookout for a time where price action is no longer able to go lower, which in this case, because we're oversold, we're just going to be on the lookout for some support to build. So we have some support building, which happened here and here and here. And the market just kind of plateaued on top of this area of support, saying, hey, we reached a bit of an equilibrium in price, and we're not ready to go lower. At this point, the buyers are starting to build into the market. The sellers don't have the power to keep pushing price lower, and the buyers are starting to jump into the market as fast as the sellers are starting to leave the market, and we're seeing that transition in power occur. And what happened shortly thereafter, after the divergence? Well, the lines came back together. Right, they got closer together and they flipped. And what did the market do during this time, to be illustrated by the MACD? Well, it started going upwards. So with an oversold indication by the MACD, we could have been prepared with some simple price action for a possible buy opportunity in the market, because we were considering the market to be, once again, a little bit oversold or possibly a little bit overbought. So we've got three clean ways where we can use the MACD to give ourselves some type of indication in the market into where price might be going. And if we just couple that with anything else, okay, some people like to use the MACD with the money flow index. All right, there's a lot of different things people will use with the MACD. The idea is to use something else that you understand. All right, I could find a way to couple a logical read with pretty much any other indicator out there, in conjunction with MACD. But my favorite personally, once again, is just pure price action. Paying attention to that old school Japanese candlestick analysis stuff, paying attention to how price is working its way, where it's finding support, where it's finding resistance. Paying attention to these things in conjunction with MACD can make it very simple to justify a solid buy or a solid sell. And we can do this, with relative ease. As you saw by what I went through with here, our three options, our first option is so simple. It's the MACD crossover, where we're just paying attention to times where the MACD line is going to cross above or below the red line in this case, which is going to be our trigger line, okay? So whatever color yours are. So it's the MACD line looking to cross above or below the trigger line, and that is an example of a crossover. Now, there's ways to add higher levels of confirmation to that and refine it down so we're not just taking 1,000 trades a day. And that would be by, obviously taking MACD crossovers that are only occurring in the direction of the overall prevailing trend, even if the crossover is occurring on a smaller time frame, things like that, or obviously using price action with it. That's one of my least favorite entry methods. Now, my most favorite entry methods are the second two that we talked about. And that's going to be the bearish and the bullish divergences that occur. Okay, the bullish and bearish divergences that occur when we see the peaks and valleys of the MACD rising while price is falling. Okay, while the peaks and valleys of price is falling. All right, while the MACD overall is traveling upwards. Okay, you got to take a step back and look at a larger sample size. We're not just looking at one up and down of the MACD. The lines might be flipping back and forth a little bit along the way, but what we're paying attention to are the highs of the MACD getting higher. Okay, while the highs of price are getting lower. Okay, that would be an example of a divergence. And obviously, we would like to see the lows of price getting lower as well. Okay, so we want to just see a general just divergence between price and the MACD. We want to see the lows and the highs getting lower while the MACD is getting higher with the highs and lows. Okay, that's all it takes. That's all it takes to pay attention to divergence. And then as soon as we use that information in conjunction with common price action and just good support and resistance entry methodology, which once again isn't overly complicated either, it really doesn't become all that difficult to identify a few good positions here and there, okay? And then our third option that we talked about today was going to use the MACD to give us an indication of how overbought or oversold the market is. And we can use that as an entry opportunity once we use it in conjunction with price action as well. Or we can just simply use that information and throw it into our knowledge bank as we're assessing the market conditions and use that to, once again, couple any other strategy that we're currently employing into the market. If we're only looking to jump into the market for buys during a period where the market is oversold, well, there's a good chance that we're finding good value, okay? And if we're only looking to buy or sell into the market when the market is overbought, okay, well, then once again, there's a good chance that we're finding ourselves some good value, okay? We like selling when the market is overbought because that's usually indication that there's a collapse coming or some type of collapse, right? And the opposite holds true. We like buying when the market is looking like it's oversold because there's an indication that there's a rise coming because the market is devalued a little bit too much. It's too cheap right now, and we anticipate people to jump on in. Okay, but those are the my three favorite methods of the MACD, and it can get a lot deeper. Obviously, the MACD has all kinds of different methods out there that people have developed over the years, but these are some of my favorite versions, and there's some of the most simplistic ways to use MACD to justify future price direction, despite it being a lagging indicator. But nonetheless, I am going to close this off here because I feel that we've covered all three methods. I feel like we found some good examples of all three. And I didn't have to throw any screenshots from anywhere else, which I'm happy about as well. And once again, as we were going through these live charts, we're just taking a look at the E-mini S&P 500 right now. And this is all today. We just kind of scrolled back the charts just a tad here. All right, there we go. Hold on. There we are. So here's current price. I didn't go digging for picture perfect examples. Instead, I tried to find some rough examples because that's most likely what you're going to find as you're going along. There are definitely better examples that can be found out there online, picture perfect examples. And the better the example, the better the divergence, the better the separation, and the better the trade signal generally is. So there are better examples out there. But if you understand the concepts behind what we're talking about, you are going to only find clearer depictions as you go along while you're trading. So I decided to start with it to be a little bit more a little bit more gritty, so that when you see the more polished opportunities, you're going to be all the more prepared. Okay, if you're able to spot the gritty ones, you're definitely going to be able to spot the very clean ones. But nonetheless, folks, it has been a pleasure as always, and I hope you have a wonderful rest of your Wednesday and the rest of your trading week. And I will see the majority of you very, very soon. But best of luck, everybody. Godspeed. Happy trading, all that good stuff. Good luck in the market, everybody. I will see you all very soon. Over and out.